What is the economic role of government and monetary authorities? Schmitt Grohé analyzes which policies can provide a stable economic environment and sustainable growth. The professor at Columbia University explains that markets don't work perfectly, and stabilization policies by governments and central banks are crucial.
What makes macroeconomics interesting is at the end of the day, you're trying to say something about policy. So it could be monetary policy, it could be fiscal policy, it could be some arrangement about international capital flows. We have this phenomenon of recessions and booms. And so we try to understand, why are these movements? Why isn't the economy extremely stable over time? The way economists try to rationalize these ups and downs is by something exogenous, meaning out of the control of the policymaker, right? So there's the coronavirus outbreak. This is something unforecastable, a surprise. There's much less travel. A lot of things are postponed for a while. That's an easy to understand example of a shock. So for a while, the main paradigm was markets work perfectly, prices adjust freely. What the new Keynesian revolution brought to that was the idea that maybe markets by themselves don't adjust perfectly, that prices were, at least in the short run, sticky or rigid and they couldn't adjust. Taking this into account gives a role for the monetary policymaker to try to influence the development so that the outcome is efficient or the economy is at full employment.
Governments or central banks try to maintain a stable and healthy economy during economic shocks. Though fiscal and monetary policy can help significantly, the system is far from perfect. When the global financial crisis hit, policies that were introduced made the recession less devastating, but millions of people still went unemployed.
Stabilization policy has a number of different instruments. If we think about monetary policy, for a long time, the way we thought about it is we just use the normal interest rate, the short-run normal interest rate, to stabilize the economy. So for example, if it looked like because of negative exogenous shocks, the economy was a bit slow, then the idea is that the central bank uses the monetary stimulus, they lower the normal interest rate in an effort to stimulate the economy. So there's this idea right now how much policy space there is. Many developed countries have the normal interest rate at zero. You cannot move it down, so you don't have a lot of policy space. And so then central banks have introduced other ways of conducting stabilization policy. If we are remaining in this environment, interest rates being basically out of the picture because they are almost at zero, there will be a bigger role for fiscal policy, for fiscal stimulus.